Hi, everyone. Thanks for waiting. We're going to start now. We were just waiting for a few more people to join, but I guess we'll just start. I just wanted to check, am I audible? Okay. Okay, so the way we're going to do this is I'm going to be presenting, and if you have any questions, you can let us know in chat, and we'll periodically look at the questions and try and answer them. Okay, great. All right, so I'll start with a bit of an introduction about myself and about Auquan. I'm Chandni Jain. I'm the founder of Auquan. I worked at a company called Optiver in first in Chicago and then in Netherlands. Prior to this, I worked as a derivatives trader there for over 3 years, and then I moved back to India last year to start Auquan. The idea behind Auquan is basically that we want to try and reach out to people who are interested in trading, and teach them about trading, teach them about the skills necessary to do automated trading. And eventually, we want these people to be able to write their own trading strategies. We basically want anyone to be able to apply skills that they've picked up in their careers and use that to trade. So the agenda for today is I'm going to start with a bit of an introduction. The introduction part has been covered in our previous talks quite a bit. So if you want to go into detail, the links are going to be up on the slides, and we're also going to share them so you can get into detail a bit later. So we'll start with an introduction of what it means to write a trading strategy. Then we'll delve into some ML. How can we actually apply ML to trading strategies? So this is not as such of a tutorial on machine learning, but more on how to apply machine learning to trading. And we'll end with some do's and don'ts of applying machine learning to trading. Okay, so before we start with the machine learning part, what does it mean to build a trading system, or what are the steps that you have to follow to build a trading system? There are 4 key steps. Identifying a strategy, which means deciding what you want to trade, how do you want to trade it, what is your logic for deciding on your buy and sell position, and what are the parameters that trigger this logic. Once you've identified a strategy, you need to backtest that strategy, which means analyzing your strategy's performance on historical data. This gives you some sort of expectation on how your strategy is expected to perform. It also helps you in optimizing your strategy, removing biases, and looking for periods where it doesn't do well, and you can go back and improve your strategy's performance on those periods. Once you've backtested your strategy, you're ready to trade in the markets. At that point, you're ready to execute your strategy. Executing means building a link to your brokerage. A broker is someone who will communicate your orders to the exchange where all the trading takes place. So you have to try and build a link to the brokerage. Execution also means deciding when you enter a trade, how much position do you want to take, how much size do you want to trade at, how do you want to size up your trade, how do you want to size down your trade. If you're trading multiple products, how do you want to allocate capital, how do you want to manage your positions, and how can you minimize transaction costs. And then finally, managing risk, which means trying to create some pre and post trade checks that make sure you're actually doing what you wanted to do and you don't run into catastrophic losses. If you want more details on each of these steps, this has been covered in a previous presentation, and we'll put the link up here so you can go into that presentation, look at it more deeply. Okay, so if for the rest of this presentation, we're primarily going to talk about identifying a strategy. Now, identifying a strategy means first deciding what do you want to trade. Do you want to trade stocks? Do you want to trade commodities? Do you want to trade foreign exchange? The rationale for deciding what you want to trade foremost is you should understand what you're trading, which is why stocks is an easy place to start for beginners. You're essentially buying value in a company, which is easy to understand, which is intuitive to understand. So stocks are recommended. Once you know what you're trading, you have to look for a strategy that you can use to make decisions. And finally, you have to optimize that strategy to try and be profitable on new and unseen data. So finally, let's talk about trading strategy. Many people do it in different ways, but this kind of flowchart makes sense to me. This is how I like to think about structuring my trading strategy. So let's look at the end part first. What is it that we want out of a trading strategy? We want something actionable. We want an order that we can send to a broker, an order which can be executed on an exchange. What does this order look like? You have to tell your broker something like, buy X shares of company Y below Z price. So you need to tell him what you want to trade. You need to tell him the direction of your trade. You need to tell him the price range where you're willing to trade at. And you need to tell him how much you want to trade for. So those are kind of the questions we want answered from our trading strategy, right? The direction, the price, the size, and obviously what you want to trade. So looking at this flow chart, you kind of have data coming in for a bunch of securities. If you're trading live, this would be live data. If you're backtesting, this would be historical data. Your data goes into a prediction model, and your prediction model comes up with a prediction. Now, this prediction in this flowchart, I'm showing predicted price, but this prediction could literally be anything. You could be predicting price, you could be predicting returns, you could be just predicting if this particular security is a buy or a sell, you could be predicting the probability that its value will go up or down. The prediction model could be predicting anything depending on how the rest of your strategy is structured, but this is the part where you come up with a prediction. Once you have a prediction, just a prediction by itself is not good enough. What action do I want to take based on that prediction? So the next step is coming up with a trading signal. What is the action that I want to take? What that means is saying, once I have a prediction price, where is it that I'm willing to buy and where is it that I'm willing to sell? Once I have those bands, then I can decide, I can compare the buy and sell price to today's price, current price, and then I can decide, do I want to buy right now or do I want to sell right now? This is not the only way to generate your trading signal. You could also just maybe directly compare your predicted price to the current price and say, okay, this is so far away from my predicted price is so far away from my current price that I want to buy or I want to sell. So there are many ways that you can generate your trading signal, either by a band where you want to trade or just a direct action that you want to take. But the idea is you move your prediction into generating an actionable signal. After you have an actionable signal, you generate your final trade order. And what goes into it is not just security data. You also look at your available funds and you also look at your current position. Now, final trading action can differ from a trading signal. Just because a security is a buy right now doesn't mean you might want to buy. There could be many reasons. You could be out of funds, you could be at your position limit, or you could be waiting for a better time. So trading strategy takes care of all of these things. What are your limits? Where would you want to start buying if you want to buy? How much do you want to buy? Do you have available funds? Are you at your position limit? If you do want to buy, how much do you want to buy? Or conversely, if you're trying to get out of a position, is this a good time to start getting out of your position? Once you've made that decision, you're ready to send your order to the broker, which means you can tell your broker something like, buy 100 lots of this security at a price of 10. Sorry, I said it the other way around. Buy 10 lots of this security at a price of 100. So just kind of summarizing what that flowchart was all about. The end goal of a trading strategy is to come up with a final trading action. Buy or sell a certain quantity of a tradable asset at a certain price. So the main thing that we're looking for to answer when we develop a trading strategy is the direction of the trade. Identify if this asset is cheap, expensive, or fairly priced. Assuming the asset is cheap or expensive, assuming the asset is cheap, do you want to buy it here? Or assuming the asset is expensive, do you want to sell it here? If you already have a position in that asset and it is fair price, do you want to get out of that position here? If you do want to trade, then what is the price that you're willing to trade at? And if you do want to trade, what is the amount of capital you're willing to put into this trade? So now that we know the kind of questions that we're trying to answer, we can actually start designing our strategy. For the rest of this presentation, we're going to focus on answering the first question, the direction of the trade. So we're going to try and identify if an asset is cheap, expensive, or fair. Everything we talk about from here on can be applied to any of these further points also, but we just take the direction as an example and go with that. Any questions so far? If you guys have any questions, please just type them in the chat and we'll try and answer them in between the slides. Okay, so coming to building a strategy to try and identify the direction of the trade, there are two sorts of approaches to designing a strategy. And these two approaches are kind of very different from one another. So the first approach is the model-based approach. That means you start with a model or an understanding of the market and why, or a certain hypothesis about why the market is inefficient. Based on this hypothesis that you have, you try and construct a mathematical model or mathematical representation of for maybe the price or the returns or whatever it is that is causing this inefficiency in the market. And then you try and test if this model is actually valid in the long term. For example, you could things like momentum trades or mean reversion trades. You basically inherently believe that there is momentum in a stock, and then you try and model that momentum with a mathematical representation, and then you try and see if this momentum is actually significant in the long term. On the other hand, there is the data mining approach. This is quite the opposite approach to model-based approach. The data mining approach means we first look for price patterns, and then we try and fit a model to it. So it's following the other way as the model-based approach. The model-based approach says we find a model that should fit the market, and then we try and see is this valid in the long term. On data mining approach, we look for price patterns that happen over time in the market, and then we try and fit something that can explain these price patterns with. So in the data mining approach, what is causing these patterns is not important. All we want to make sure is these patterns keep repeating so that we can take advantage of this pattern. Some problems with the model-based approach is it's not the true reality. It's just a simplified representation of reality, which means you really need to make sure that whatever your model is actually significant in the long term and is stable in the long term. On the other hand, the data mining approach, the problem is since you will be throwing so many models, so many data modeling techniques at your strategy, at your data, you need to make sure that the pattern that you've actually picked up is a real pattern in the market, not just a random pattern. If you're going to throw a lot of models at your data, it's very likely that something will come up with something profitable, but it might just be that you're really overfitting and not having your model doesn't have any predictive power on your data. So you really, really need to make sure that what you've identified is a genuine pattern in the market. Some examples of model-based strategies are, like I mentioned, momentum strategies, mean reversion strategies, and some example of data mining strategies. What is really popular is doing trial and error technical analysis. So people will draw multiple kinds of candle charts or multiple kinds of bars and try and see what explains, what generates a profitable strategy. So thinking about the data mining approach, that lends perfectly to creating a machine learning model, right? Now you have a bunch of features, a lot of indicators about the market. All you need to do is now try a lot of machine learning models and see which one can explain the market well, which one can explain the price of the asset that you want to trade well. So really simple, right? Data mining approach, machine learning. Except not really. There's a lot of machine learning itself is not simple, and then when you try and start applying it to stock price, it becomes an even more difficult problem, and we'll shortly see why. But before I get into that, for people who are new to machine learning, this is kind of what the sample framework of a machine learning system looks like. I would like to say again, this is not a machine learning tutorial, but I'll just cover some very, very basics of some machine learning strategy, some framework, but what we're mostly going to talk about is how do you apply the techniques to trading. So this is what a sample machine learning framework looks like, especially when applied to trading. You have a bunch of historical data, which means with varying time, you have some features. Let's call them x1, x2, x3. Let's call this whole feature set x. You have a target variable that you want to predict, y. You take these features x, you train a machine learning model so that it predicts y as closely as it can. And then once you have a well-trained model, you take it on new features which become available to you at a future time, but you don't really know the target variable y, and you try and come up with the best estimate of y. That's roughly the machine learning framework. This matrix here is called the feature matrix. This can be a multidimensional matrix. I've just drawn it like that for simplicity. And the target here that you're trying to predict, that's the predicted variable that you want, that this is something that you will take action on. One more thing, for all the demo here, I'll be using Auquan Toolbox. If you want to follow along, you can install the Auquan Toolbox by the command on the screen, pip install -u Auquan Toolbox, really simple. For all the machine learning models that we'll be using, I'm using scikit-learn. Again, it's a simple Python install. There is, if you want further documentation about our toolbox, there's also the link at the top where you can read more about our toolbox. There's a wiki there that has a really good documentation about the toolbox. Just a simple word about our toolbox. For anyone, if anyone here who participated in the competition, you already know how to use it. But if you don't, most of the work is done for you under the hood. All you have to do is create a simple class, something like what I'm showing you the screen, and you need to specify some very simple things like where are you getting your data from. In this case, the data is already broken into training and test data sets, so I'm just specifying the training data set that I want to use. But we also have data parsers for Yahoo, Google, NSC, and such. So you can just simply say, I want data from NSC, in this syntax that our toolbox understands. You need to specify what symbols do you want to trade. Here, this MQK is just a scrambled stock name. You need to specify the features that you want to use to create your predicted variable. Specifying features is really simple. If you install the toolbox, you'll see it comes with a lot of pre-written features. If you're using any of the pre-written features, all you have to call is the name of the feature that is written, a feature ID, how you will be calling it later in the toolbox, and some parameters which the feature expects. For example, here I want to calculate the exponential moving average. So the feature name to call is exponential moving average. I'm calling it exponential moving average 3. And the parameters that it wants a period over which I want to take the moving average, and the name of the feature of whose moving average I want. So that's it. I just need to specify this dictionary, and it's going to calculate an exponential moving average for me. Similarly, here I want to calculate an RSI, and here I want to calculate a momentum, and all I need to do again is specify the feature ID I want to use, what I'm going to call it, and the parameters. If you want to use some features that are not available and that we've not written, you can either send us a feature request, or you can create your own custom features. We do have that functionality. I'm not showing it here for simplicity, but that's available. Finally, when you've created all the features that are needed, all you need to do is combine those features in a meaningful way to get your prediction. So here, for example, I'm using three simple features. I'm not creating them above, they're just present in the data set already. And I'm just creating my prediction variable simply from these 3 features, and I'm just returning that as my prediction. And that's it. That's all I have to do. After that, everything else, the toolbox, or if you want to run a backtest, the toolbox takes care of everything else, how to execute, how to place trades, how to calculate fees, P&L, capital requirements, all of that is done for you. So really, to use the toolbox, all you have to do is fill in this class. All right, so getting started with machine learning. Step 1, set up your problem. What is it that you are trying to predict? This is, people kind of go wishy-washy over this, but I think a good understanding of what exactly is the problem that you're trying to solve is really important to set up your problem right. And if your problem is not set up right, generally your machine learning models are going to fail. So what kind of a prediction are you looking for? As I mentioned before, you could be predicting many things. You could be trying to predict a future price. You could be trying to predict the future returns of your security. You could be trying to predict a buy or sell signal. You could be trying to optimize a capital allocation in your portfolio. You could be trying to make your execution more efficient. You could be doing some unsupervised reinforcement learning. But it is really important to understand what is it that you're looking for? What is it that you want an answer to, and model your problem accordingly. So if we go back to the sample framework that I was talking about before, I said there is a feature matrix. All of these are the features that have some predictive power that we're going to use to make a prediction. And then we're going to use these features to make a prediction for Y. So what is Y in your problem? This is before you even start, you need to think about what is Y. What do I want to predict? You could be predicting price at a future time. So in this case, we see how price moves with time, and then you want to predict the value of this price at a future time. You could be trying to predict the direction of price at a future time. So you don't care what the actual value of price is, you just care if the price goes up or down. Or you could be trying to predict returns of the security. But it's really important to know what is my Y. Once you have decided what is Y, you can actually set the value of Y. So let's go with the assumption that I want to predict price at the next instant. Okay, so that means at time t, I want to make a prediction on the value of price at time t plus 1. Now I can actually just I can complete my framework. Now I know what my value of Y is at every point. At every point in time Y, when I'm training at every point in time t, when I'm training my model, the value of Y is the price at the next instant. So In this case, I have my feature matrix, I have my target variable y, and at every point t, the value of y is price at t plus 1. At time t plus 1, value of y is price at time t plus 2. And now I have my target variable that I want to predict. Knowing what y is also helps you decide how will you evaluate your model. And this is important for actually comparing models. So in this case, if you're trying to predict the future price, one way to evaluate a model is how far are our predictions actually from the how far our predictions are from the actual value that we see observe in the future. So we could do something like we'd say, okay, we take the root mean square error of our predictions. And root mean square error is simply the average square deviation, the square root of average square deviation. So that gives you a good estimate of how far do your numbers lie from actual values. For the purposes of demo in this presentation, we're going to use a problem from our competition. So this is the first problem in QuantQuest. If you were participating in QuantQuest, if you did, you can go to the QuantQuest website and look at the problem. But the gist of the problem was this: we want to create a prediction model that predicts future expected value of basis. What is basis? Well, I don't want to go into too much jargon, but for the purpose of this presentation, it will suffice to know that for the purposes of the presentation, it will suffice to know that there is stock, and with every stock, there can be an associated future. Basis is just at any point in time the price of the stock minus the price of the future. If that's also too much jargon, don't worry about it. In the data set, basis is already calculated for you. All we have to do is try and come up with something that predicts the future value of this basis. So basis is simply price of stock minus price of future at any point in time t, and our target variable, what we're trying to predict, is the future expected value of basis. In this case, we say we will take the future expected value of basis as the value of basis 5 intervals forward. So at every point in time t, when we have the values of stock price, future price, and the value of basis at time t, we want to predict the value of basis at time t plus 5. To complete the setup of the problem, since this is a regression problem, we will evaluate the model on root mean square error. One other criteria that we'll be using to evaluate a model is also total P&L generated by a model. In the end, we're trying to trade, right? So we want the P&L to be as high as possible. So our objective here is to create a model so that our predicted value is as close as possible to y. Just putting it back in the framework perspective, we have a bunch of features. Some of our features now will be the stock prices at every point in time t, the future prices at every point in time t, the value of basis at every point in time t, which is just st minus ft. And then our target variable would be the value of basis at time 5 intervals forward. So at time t, the target variable y is the value of basis time t plus 5. At t plus 1, the value of y is the value of basis at time t plus 6, and so on. Okay, one very important thing to note here is this target variable y uses information from the future. If we were trading live, if time t was the present time, we would not know the value of basis at time t plus 5, right? The only reason we can do this is because we are backtesting. We are training our model on historical data, which means in the past, now we know what the value was at time t, and we also know what the value was at time t plus 5. But when you start trading live with this model, you will not know what the value is at time t plus 5. This is what you're trying to predict, and 5 intervals later, you will be able to see how good or bad your prediction was. This seems obvious, but I'm mentioning this because when we start training our models, we might forget this, and we might start using the value of y as if it is known to us at time t. But it is important to remember that the value of the target variable could be using information from the future. In this case, it is actually information from the future, but it could always be using information from the future. And so we should try and avoid using y. In fact, we should just always avoid using y in our prediction models. Our root mean square error in this case is just the actual value of y minus the predicted value of y, the average of the deviation, the average of the square deviation. Okay, so that completes our setup. Just showing it to you guys in terms of code. I'm just downloading a file, and this is what my data looks like. I have stock price at every point in time t. I have future price at every point in time t. The value of basis is just stock price minus future price. And the value of my target variable y, you can see, is the value of basis from 5 points in the future, 5 intervals in the future. right? So value of basis at 917 is the value of target variable y at 917 is the value of basis at time 922, and so on, so forth. Okay, so now our problem setup is complete. We know what is it that we're trying to solve. The next step is trying to collect reliable data. Collecting data that will help you that will help us solve the problem, and making sure this data is clean, accurate, and reliable. In this case, let's think about our problem. Okay, so what data will have predictive power? Stock price data, stock trade volume data, maybe some sort of fundamental data about the stock, maybe price data of correlated stocks, some sort of an overall market indicator. Is the market going up or down? Price of similar assets. For example, you could be trading some stock that has a lot of foreign exports, and then for that stock, maybe the value of USD INR exchange rate may be important. Or you may be trading oil stocks, and then for those stocks, the actual value of oil might be important. So you just really have to think about what data will help me predict this problem that I'm trying to solve in the best possible manner, and try and collect that data. Once you're done with the data collection stage, you have to make sure your data is accurate. Generally, financial data, especially because of how bad people are with storing it, comes with a lot of inaccuracies. There might be floating point errors. Data might just be missing for days. Data might be they might be writing errors. I've seen lots and lots of errors. So just make sure that your data is accurate, and just do a sanity check on data. Run through all the data, make sure the data looks right, make sure the data is seen what it should be. And then also you have to clean the data for any sort of price action that is going to misinform your judgment. For example, if you're looking at stock data, then you have to clean the data for dividends, stock splits, rolls. You have to clean the future for rolls, etc. What will happen is, for example, if you just take the case of a dividend, if you have not cleaned your stock for a dividend, it will look like the stock price moved a lot compared to the future price, when all it was an adjustment in the price of the stock, so the dividend. So make sure you clean your data for all sorts of things that don't have any predictive power, which will just creep in some inefficiencies into your data. I should mention, if you are using Auquan Toolbox and you're using data from Yahoo, Google, or NSE, or Yahoo, Google, or NSE data parser, then we already clean data for stock, dividends, and rolls. To the extent that that data is correct in Yahoo, NSE, or Google, where we get it from, but the data is already clean for you, so you don't have to worry about cleaning it for that. So in this problem, we collected data at minute intervals for over 7 months, so trading days for 7 months. That roughly amounts to 55,000 data points. We collected information like the stock bid price, the stock ask price, bid volume, ask volume, and then the future bid price, ask price, future bid volume, ask volume. We also created some more features from the data ourselves. So you might see these later in the presentation, so I thought I'll just say what it means. The stock VWAP is stock volume weighted average price. That's just bid price into ask volume plus ask price into bid volume divided by ask volume and bid volume. Similarly, future VWAP. Once we collected all of this data, we cleaned this data for dividend splits and rolls. So if you were solving the problem on Conquest, or if you go back and try and attempt this problem now, this data is already cleaned, so you don't need to worry about cleaning the data. I'm just listing all the data that is available to solve this problem. You can see there's a bunch of bid volumes, bid prices, ask volumes, ask prices, both for the stock and the future. There is a stock VWAP, our future VWAP, the basis itself, and our prediction variable Y. All right. So we've decided on our problem. We've collected our data. The next step is, before we start doing anything at all, is splitting our data. This step is super important when you're applying machine learning. I cannot stress how important this is and how many people actually fail to do this properly. So what I mean to say is, when you will be training your algorithm, ideally how this will work is, you will look at your feature matrix X, you will run through some standard machine learning models, you will optimize them, you will iterate over them, you will come up with prediction variables Y, and you will see what your error is, or whatever you have chosen to evaluate your model. And if that doesn't meet your standard, if it's too high, you will go back and re-optimize. Now, if as you keep doing this over and over and over again, you might start overfitting on your data that you're training over, which is why it is super important that you split your data into training data and test data. Once you do that, what will happen is, you train only on your training data. So when you're creating your machine learning model, you train only on your training data. And then when you want to evaluate the performance of your model, you look at the performance only over test data. So the data that your model has not been trained over. Obviously, your model's performance on data it has been trained over is going to be good because you trained it on it. You fitted to it really well. What you need to make sure is your model's performance is good over data that you have not seen before. The recommended split usually is keeping your training data at 60 to 70% and test data at 30 to 40%. But make sure you make the split before you proceed, before you do anything else, before you do any sort of feature engineering, before you start to look for correlation between features, before you start to look for relevant features, anything at all. Make sure you first split your data. If you use your test data to make any of the decisions, that data is tainted. You cannot. Your results are going to be biased. Your results are going to not hold over new and unseen data. Okay. Now, even with this picture, with this split of data, there is a problem. The problem is, let's think about what's going to happen. I'm going to use my feature matrix. I'm going to create some machine learning models. I'm going to use those models to make a prediction, and I'm going to do that iteration over and over again on my training data until I'm happy with the results. Then I'm going to run this model on my test data, and I'm going to evaluate my model. Chances are, the first run, my model will not perform well in the test data. Okay, I did something wrong. I'm going to go back to the drawing board. I'm going to start figuring out new features that I can add. I'm going to start trying out new models. I'm again going to repeat the whole exercise on training data. I'm going to come up with a new model. I'm going to try that on my test data again. And then if it doesn't do well again, I'm going to go back and do the whole thing over and over again. Now, by doing this, you've kind of now started optimizing your model to test data as well, right? Because every time you train your model on training data, and then you test it on test data, and you use the results on that test data to make a decision on, okay, I'm going to go back and choose a new model. I'm going to go back and retrain my model. You're kind of using information on the test data. But when you start trading live in the market, you won't have that luxury. You can't go back. You can't take the model, work with live data and say, okay, no, wait, you know what? I'm going to go back and change my model and then trade over this period again. So this kind of split is not really going to work very well. Your test data becomes tainted, and slowly, as you iterate over multiple models, it becomes kind of a part of your training data. So how do we overcome this problem? Okay, well, that's just saying that you predict your Y, you validate over your error. Okay, so one way to do this is create a separate holdout or a validation data set. You can either do this within the training data that's available to you, or you can take some of the data out of your test data and say, this is my validation data. What the validation data will allow you to do is what test data was doing previously. So now your test data is just untouched data that you promised to never touch until you have a final model that you're very sure about. But you can use your validation data to optimize your model. So now you use your features X, you create a machine learning model, iterate over many machine learning models and all the parameters and everything, and come up with a model that you like. Once you like that model, you test it on your validation data. You test it on your validation data, you get the error. If you're not happy with the error, you go back to the drawing board, you create and you re-optimize, you go back to the drawing board, you create a new model, and you do the whole training on the training data again, and then you test it again on your validation data. And then if you're not happy, you re-optimize that again, and you keep repeating that cycle until you have a final model that you're actually happy with. Once you have that final model, and only once you have that final model that you say, okay, I'm not going to iterate on this model again, then you test it on your test data. And then once you test that final model on your test data, you just accept the error that you get. Don't go back and train your model or optimize your model again. Then your test data becomes tainted. If you find that the final model has an error that's not acceptable, just discard that model, start over again. But do not go back and retrain that model. This will give you a good picture of how your model will perform on new, unseen data that when you start training live. If you go use your test data to optimize your model again, then yeah, well, we've already talked about what happens then. Okay, so for the problem that I'm demoing with, we're using the following training validation test data split. You can see that here as well. So my training data is about 50% of the total data points available to me. My validation data set is about 25% of the total data points available to me, and my test data set is about 25% of the total data points available to me. When we were running the competition, the way we structured this was we gave a bunch of data which the participants could download. And then they could use this data as a training data, and they could optimize on this data. And once they were happy with the trained model, they would submit it to us. We would run it on the validation set for them. They could not download and train on the validation set, but they could see the results of their model on the validation set. This made sure the validation was true validation set and people not using it in the training set. Once they saw the results of their submission on the validation set, they could go back and retrain their model on the training data and submit a new solution. And then we would rerun it for them on the validation set and show them new results. And then this process would go on and on until they were happy with the final model or until the competition ended. Once the competition ended, we ran everyone's submissions on the test data. But now they're not allowed to change their submissions. So what that means is now we actually truly know how their well-optimized models will perform, or well, we have a much stronger probability that the performance that we see on test data is more representative of how this model is supposed to perform on new data, unseen data, when we start trading like the market. All right, so that's enough said about data split. Finally, now we split our data into training, validation, and test data. Now we can come to the interesting part, feature engineering. So what that means is you analyze the behavior of your data and try and create features that have predictive power. A golden rule of feature selection is that predictive power should come from the features and not from the model. Which means that what that rule kind of translates into is that choice of features is actually far, far more important than choice of model if you want to impact your performance. So some things to keep in mind: don't just randomly choose a very large set of features without exploring relationship between target variables. We saw this in the competition. People just iterated over all possible features that you could generate in that toolbox with all possible data that was given to them, and then just try to train models with that. The problem is if you choose variables which have little to no relationship, you will just almost always lead to overfitting. Consider an example where there is this one feature that has almost zero predictive power on your target variable, but just by random coincidence, one time when you have a giant spike in your target variable, there also happens to be a giant spike in this feature, which otherwise has no predictive power. It will seem like this feature has some predictive power, and then your model will kind of try to fit to that, and it will improve your model performance. But in reality, that's not the case. It's just spurious correlation. So to avoid situations like these, if once you create your set of candidate features, please analyze each feature and make sure that that feature has at least some predictive power. People do different things. I generally just look at correlation of the feature with the target variable, and I set a correlation cutoff, and I say I'm only going to use features which have at least this much correlation with the target variable. Other things that you could try is use maximal information coefficient. So you just rank all your features according to MIC and say take everything above a cutoff, or you can do principal component analysis to sort of reduce the dimensionality of your system. I'm not going to go into those methods. There's a lot of literature out there on how to do it. The important point is select your features well. Select features that actually have some predictive power on your data. The second thing, if you have been practicing machine learning, you will already know this. Feature transformation or feature normalization works really well with machine learning methods. The problem is that kind of becomes tricky in finance because the future range of your data is unknown. So how do you actually normalize? You can say, okay, I'm going to take the max and min over all the data that's known to me and try and standardize data to a certain range. But it is quite possible you might see a number which is much larger or much smaller than anything that you've seen so far in the future, and then your normalization is going to fail. Even then, so I understand normalization is tricky, but even then, just try and enforce some degree of stationarity in your data. So some of the things you could do is divide your features by a rolling standard deviation. So standard deviation taken over a rolling historical period. So scaling your data, or you could try centering your data by subtracting a rolling historical mean from the current value. You could normalize your data by doing both of the above. Or you could finally, you could try and just regularize your data by making it stick to a range of -1 to 1. One very important caveat here is since you're using rolling historical means and standard deviations or max and mins to compute this normalization, the same normalized value will mean different actual value at different times. So what I'm trying to say is if the value of a feature is 5 and you're centering it by subtracting historical mean, and the historical or the moving average mean, the moving average of the last let's say 30 periods right now is 4.5, then your normalized value comes to 0.5. For the same feature, when the value is 6, but the moving historical mean again is 5.5, the normalized value will again come to 0.5, but the actual value of the feature is 6 versus it was 5 before. So just be aware of that if you're using some sort of a rolling or a historical moving standard deviation to normalize your data, the same normalized values can lead to different actual values, and that might affect your model. So feature transformation is good, but it just varies from system to system. As a rule of thumb, I'd say if all your features lie within an acceptable range, maybe just avoid normalization completely. But if the numbers are vastly varying, for example, if you're using the percentage difference in moving average as one feature and trade volume as the other feature, just magnitudes of difference, then definitely normalize it. Okay, so in the current problem, just to kind of show you what happens when we choose large number of features, I just went on a crazy feature selection mode. I just wrote all kinds of exponential moving averages. And okay, so let's start with, I thought, okay, the exponential moving average of the bases might have some predictive power. I also thought RSI and previous momentum might have some predictive power. But I don't know what period to take on. So I just created multiple period exponential moving averages. I created multiple period RSIs, and I created multiple period momentums to calculate this. Just a point to note, here I wanted to create different period RSI, momentum, and an exponential moving average. All I had to do in our toolbox was just specify different feature keys. So a 4 period moving average, exponential moving average as a key of exponential moving average 4, and the rest of the code remains the same. I just have to change the param name. Same thing for RSI, I just have to call the feature ID, give it a period, and that's all. And I change the feature key. Same thing for momentum. Anyway, so I created a bunch of features, and then using these features, I created a lot more features. I'm also using some things as the stock average bid and ask prices, average bid and ask volumes. But as you can see, I just created a lot of features. At this point, I haven't really analyzed what feature has predictive power. It just things that kind of made sense logically to me. I just created a whole bunch of those. Now we'll see how that actually performs on our data. So now that we've selected our features, the next step obviously is model selection. Model selection depends on the problem that you are looking to solve. So are you solving a supervised or an unsupervised problem? A supervised problem would look like the problem that we're solving now, which would be saying we have given feature matrix. Each point in our feature matrix maps to a certain target variable y. So for every point x1, I have a corresponding point y1, and I'm trying to make my machine learning algorithm learn this pattern. What pattern can it learn so that it maps x1 to y1, x2 to y2, x3 to y3? That's a supervised learning problem. An unsupervised learning problem would say, I have a feature matrix. I'm not mapping it to anything, but I'm trying to maybe say I want to maximize my profit. So how do I maximize my profit? I take buy and sell decisions. So given this feature matrix, can I learn to make intelligent buy and sell decisions so that my profit is maximized? So you're kind of learning unknown patterns here, and this would be an unsupervised problem. So depending on how you've modeled your problem, are you doing a supervised learning problem or an unsupervised learning problem? That would be the first thing that would dictate your choice of models. The second thing would be, are you solving a regression problem or a classification problem? So I gave 2 examples at the start. A regression problem would say, I'm trying to predict the actual value of something at a future time. So for example, I'm trying to predict the future value of price or the future value of returns. A classification problem would say, I don't care about the future value. I'm just trying to bucket future events into one of many possible buckets. So I'm trying to say, for example, there are 2 possibilities, price will go up or down, and I'm just trying to predict that. I don't care what the actual magnitude of movement in prices. Or I'm trying to predict the sign of future returns. Or I'm trying to make a buy or sell classification for a stock. You can also know that many of these can be derived from one another. So for example, if you're solving a regression problem, then you could use the results of your regression problem to make a classification. And well, you could come to vice versa. But so it really depends on how you framed your problem at the start. Some common supervised learning models. I'm not going to go into details because, like I said, this is not a machine learning tutorial, but some of the common ones that I've used in the past that are kind of common in the trading world, linear regression, logistic regression. Linear regression, logistic regression are actually parametric learning models. So what that means is for linear regression, I'm trying to say that I have for each of my feature point, every point X in my feature matrix, I have a corresponding point Y, and then I'm trying to come up with a linear model so that I can combine all my features in a linear fashion to come up with this value Y. So something like, when you try and predict a line, that would be linear regression. What's important here is I'm trying to learn certain parameters that can then combine my features X in a linear manner to come up with a prediction Y. Logistic regression is also a parametric learning model, except instead of directly predicting Y, you're just trying to classify Y. So it's similar to linear regression, except it's a classification model. A non-parametric model would be K nearest neighbors. That's an instance-based classification model. So here, I just learn all the instances. What feature mapping in X maps to Y? What feature mapping in X maps to Y? And then now when someone asks me, okay, I have this feature mapping X, what is the value of Y? I just look at its closest neighbors and I take the average of the Y value, or a distance weighted average, or whatever your method is. But basically I just keep all of these instances. I just remember them, and then I find whatever new instance you throw at me, I just find, okay, what was the closest that I knew to it? And then I try and answer according to that. Whereas in a linear regression, I'm just trying to learn a parameter that can help me predict. That's the difference. Other popular ones, SVM can be used for both regression and classification. I'm not going to go into details there. Decision trees, decision forests. Decision forests are just a collection of it's just a collection of many decision trees. And decision trees are simply just a tree-like structure where when you're trying to predict something, at every point, at every node, you make a yes or no decision. A decision could be something very simple, like, is the value of feature x1 less than this? Yes. Okay. Is the value of feature x2 greater than this? Yes. Okay. Is the value of feature x3 less than this? Yes. Okay. Is the value of x4 higher than this? No. Okay. Then is this? And then you traverse down the tree. If you finally reach a leaf, and that leaf is your prediction. If you do this on multiple trees, it's a decision forest. This list is not exhaustive, obviously, and I haven't even gone into near detail about what each of these mean, but the idea is that you go learn about machine learning yourself. But if you're looking to start, these are some of the good ones to start with. Okay, so for the current problem, let's start with the simplest one. Let's start with linear regression. Like I said, I'm going to be using scikit-learn, so I'm just using their linear model, and yeah, that's how I call my model. So now, let's see what happens when given my current set of features, my current split of data, when I try and train a linear model on it. So that brings us to step 6, train, validate, and optimize. We've already talked about this framework. We've created a training set, a validation set, and a test set. What we're going to do now is we're going to train a model using using features in our training data set. Look at the predicted model, look at the prediction Y that comes out of it. If we don't like it, we're going to optimize our model, change our parameters, whatever it takes to come to a point where we're happy with the prediction Y. Once that happens, we're going to test it on the validation set to test a model, to evaluate a model. If we like the evaluation, we'll go forward. If we don't, we'll go back and re-optimize the model on the training data set. Okay, so here I load my training and test data sets. I'm calling it test, but I'm actually loading it from my validation data set. This is not the so my test data here is my validation data. I call the linear regression model that I had created previously, and I do a model fit, and then I look at the prediction of my model. So one thing to remember here is I had created a lot of features. If you remember, a lot of features. I haven't normalized them. I haven't done any sort of feature selection. I just created features that sort of made sense to me that this might work, and I just trained them with the linear model. So this is kind of what my final output trained model looks like. You can see it's really messy. There's a lot of features. The coefficients of these models don't really mean a lot to me right now because I don't know what the scale is. So for example, this one has a coefficient of 10 to the power minus 7, but I don't know what the scale of V12 is. I don't know how big or small it is compared to, for example, S width. So I don't know if this V12 is actually significant with respect to S width or not. There's also just a lot of models, and probably not all of these models are significant, right? So this model clearly needs some work. Just in terms of numbers, the root mean square error of this model was 0.25. Compared to that, the standard deviation of basis for this particular stock is actually 0.59. So this is clearly not a very good model. The P&L generated over the 6 months period that we tested, 5.5, I think, 5.5 month period that we tested this on was 8%. You can also just look at the P&L chart here, and you see the P&L is kind of jumpy, and this is kind of not the P&L chart that you want to look at. You want a P&L chart that's kind of smooth, that's trending up. This could just be a fluke. We could have just caught one trend. We could have just been lucky, and then this might or might not happen in the future. So we can't depend on that. So if you exclude that, the P&L is okay. It slowly goes up. It's not great. There's clearly a lot of work that can be done in this model. Okay, so then the first obvious step to do is normalization. So here I'm just doing I'm taking a prior 30 period rolling mean and a prior 30 period rolling standard deviation, and that's how I'm normalizing my data. And here I've also done some sort of a feature selection. So I've cut down on some features. I'm not so going into all those details here. And I guess we're also running out of time, so I'll go a little quickly now. I've done some feature selection here as well. And I've normalized my data. And now you can see my root mean square error compared to the previous one has already improved, 0.182. My total P&L has also improved. And if you look at my P&L now, other than improving, it's also not that jumpy anymore. It's kind of trending up slowly. There's still that small jump here around the same time, but that's not the only major contributor to my P&L. The P&L kind of just goes up all the time. So I do like this model a lot more than the previous one. So what I did here, if you see between these two, is I trained my model on the training set. Once I was happy with the results of my training set, I tested it on my validation set, which in the code I'm calling as test set, but it's my validation set. I look at the results of my validation set and I say, okay, I need to go back and I want to improve my model. Then I improve my model. I again train it only on my training set. And then I look at the results of my validation set again and I say, okay, maybe I can go back and do more things with this model. So up to this point, we've only tried linear regression. We tried a bunch of other things. We tried SVR regression. We tried an extra trees regression. And finally, something that worked for us for this particular problem was a gradient boosting regression. That's the code there. I'm not going to go into details of this model again, but you can see that we ran, after running through many iterations of training data, we finally came up with a model that we were happy with. You see now I've definitely improved my root mean square error by a lot. My P&L numbers are much higher. It's almost 2.5, it's more than 2.5 times of my original number. And if you look at my P&L chart compared to the original one, it's trending up. It looks better than both of them. There is still that small jump on that date, but that's nowhere even the major nowhere close to being the major contributor to my P&L anymore. My P&L chart is good. It trends up slowly, and this is something that I like. So two main things to note here is I trained on my training set. I tested on my validation set, but I did it so many times. I think I must have gone over 10 models for this at least, and then for every model that I went over, I optimized my parameters based on the results on the validation set. The validation set almost becomes a part of my training set, right? Which is why it is super important to have that validation set, that you're optimizing, you're testing your results over, and you're going back and optimizing, but you still have this final test data set that you've not tainted at all yet. You haven't taken any decision based on the performance on test data set. All right, so now we've come to a point where we've iterated through a bunch of models, we've trained them, we validated them, and now it's the moment of the truth, right? We want to check for performance on real outer sample data. Right, so we have a final model, we train on training set, we test on validation set, and finally we use the test data set and we see what the error is. It's very important to note here that I'm only going to look for my error and see if this is a model I'm going to trade or not. And that's it. If I don't like it, I'm going to discard this model. I'm going to attack this problem from the start, but I'm not going to go back and optimize my model based on this. Okay, so let's look at the results of our gradient boosting model on the test data set. Okay, it definitely does worse than it performed on the validation set. which makes sense because we'd optimized it so much on the valid, because like I said, I kept optimizing on my after looking at results of my validation set, but it's not so bad. It's still doing better than those linear regression results. And if you look at my total P&L, okay, there's this big jump here, and it's not that nicely growing chart that it was before, but it's still not bad. It's okay. And clearly this model does need a lot more work. I need to get rid of this jump, but the total P&L is 3%. It's important that this 3% is over a period of 2 months versus the other result was over a period of 5.5 months. So obviously this number is smaller, but if you take an annual number, they will kind of be in the same ballpark range. What I'm not doing here is, I'm not saying, oh, there's this jump, let me go back and retrain my model. I'm just saying maybe the gradient boosting is not the answer. At least with the current features, it's not the answer. If I do go back and train my model, I have to remember to now get new test data. So maybe wait until a month or so to get new test data before I can make a decision. But not work with this test data anymore because it's tainted now. Okay. There are other ways to improve your model performance. One thing that I used was a rolling validation that I haven't mentioned up till now. What we've been doing so far, I was saying that, let's say you have data from January till June, then you split data into, say, January to March you use, or January to April you use as your training data. Your data in May can be your validation data, and your data in June can be your test data. One problem with that is that market conditions change all the time, which means that the conditions that existed in January, February may not exist in May or June, which means you will be training over different market conditions, you will be testing over different market conditions, or so you might do great on training data, you might perform horribly on test data, and that doesn't mean your model is bad, or your validation data, that doesn't mean your model is bad, it just means you've trained on a different sort of data and you've tested on a different sort of data. So one way to solve for that is try and do a rolling cross validation. So what that means is you train over some part of the data, you come up with your model that is well optimized, you test it on your validation data, and then when you're going to go back and improve, use training data from the next time period. So in our example of data going from January to June, this would mean maybe use data from January, February as your training data, use data from March as your validation data, and then use data again from April and May as your training data, and use data in June as your validation data. And okay, in this case, we run out of data because we don't have any test data, but that's the idea. So when you do this, when you do this rolling cross validation, you keep rolling forward with your data, you kind of make sure you're training over different market conditions, assuming you have sufficient data. And that kind of avoids overfitting to one type of a market condition. And then when you have your final model as a result of this rolling cross validation, you can finally test it on your holdout data. Some of the other things that people do are ensemble learning. This is a big part of what we are looking to do at Auquan. What that means is you train, let's say you choose a k-nearest neighbors algorithm, you train one model using that. You use linear regression, you train another model using that. You use SVM and you train another model using that, following all our principles of training, rolling validation, cross validation, and test data. And then when you make your final prediction, you use your test data, you come up with a prediction, and then your actual true prediction is the mean of all these predictions. But how does that help us? That helps us because if one model is overfitting, the other two will overcompensate for that. If one model doesn't fit on a particular type of market condition, the other two models will take care of that. I'm only showing 3 models here, but this is actually very, very popular in the finance industry. People use hundreds and thousands of models to train their algorithms and then use the ensemble of the results of all those models to come up with the predicted value. So yeah, like I said, doing an ensemble learning is going to reduce your error, is going to reduce overfitting. There are other things you can do like bagging and boosting. I'm not going to go into those details. That's just too much detail for now. But if you're interested, we're going to share these slides. You can look at it. Yeah, for the current problem, the only thing that we're doing here is rolling cross validation. So I had data from June to September. What we did was we had data from January to September. So we used January, February as training. We used March as validation. We used, based on those results, we used April, May as training. We used June as validation. And then we used July, August as training, September as validation, and then October, the data for October as our test data set. Roughly around that split. Okay, so just to recap quickly everything that we've talked about. How do you go about identifying a signal? First, set up your problem. collect reliable data and clean that data. Split your data into training, validation, and test sets. This is super important. Make sure you do this before you do anything further, before you go any further. Once you have done that split, look at your data, look at the data in your training set, create features, analyze behavior. Feature selection, again, super important. We saw how our model performance improved once we selected the right features and normalized them correctly. Choose an appropriate training model based on the kind of problem that you're trying to solve for. Use your training data to train your model and make predictions. Check performance on the validation set and re-optimize. And finally, when you're done, you will go in over these two in many loops. And finally, when you're done, when you're happy with your final model, verify performance in the test set. And hopefully after this, you have something that gives you a trading signal. And that's not even the end of it. Now you only have a trading signal. The next step in identifying a strategy is to actually identify the trade direction based on your prediction model. And once you have the trade direction, it is to identify entry and exit points. And once you have those entry and exit points, it is to identify sizing, how much you want to trade, and the price you want to trade at. And each of these problems can be solved in the same way using machine learning techniques. The idea here was to show just one way of how to approach this problem using machine learning. Once again, I was using Auquan's Toolbox. If you were following along, or if you want to try out what we've talked about here, it's a simple pip installation. Everything the code that we showed here, we're going to upload an IPython notebook on our GitHub tutorials page soon. So maybe by tomorrow. So you should be able to try out everything that we've talked about here. And finally, before we take questions, some do's and don'ts that I really want to mention. One, avoid overfitting. Please avoid overfitting. Overfitting happens when you don't break your data sets properly, or you don't even have a test data set. You create too many features and you don't do feature selection, so you're just giving way to unimportant features. When you've tried too many models without really figuring out, is this model capturing a trend, or is this model just because I tried so many models on my system, something came out with a positive result. So please avoid overfitting. Don't retrain after every data point. This is something that we saw in our competition actually. People were submitting models that were training on the go. So what that means is you have data from time 0 to t, and you make a prediction at time t, and then data at time t plus 1 becomes available, and they retrain the model, and then they make the prediction at time t plus 1. That's not optimal. That's not even right. If your model needs to be trained after every data point, probably just doesn't have a lot of predictive power. I'm also not saying your model doesn't need to be retrained, but the frequency of retraining needs to make sense. Maybe for something like this, retraining daily would make sense, or retraining every few hours would make sense. For models that operate on a lower frequency, retraining every few weeks or every few days or every few months would make sense. But retraining after every trade you do, or retraining after every data point, does not make sense. So don't train on the go. Train your model, test its performance, use it to trade live. After a certain time period has passed, then go back and retrain the model. Don't retrain it after every data point. One more very important thing, avoid biases, especially local height bias. Now this ties back to what I was saying at the start, that a target variable y almost always will contain information from the future, information that is not available to you right now. You can do that in backtesting. You can define y as you're defining, because all that information is available to you. It's all happened in the past, but when you will actually start trading live, that information will not be available to you. So it's super important to make sure your model is not using your target variable to come up with a prediction. I mean, if you have information from the future, of course your model will do well. But without that information, how does your model do? A lot of people did this in the competition. They were using the target variable to train, and without inherently understanding that has information from the future. So any feature that you're using, understand what is that feature, what does that feature represent, and make sure that is not looking ahead, that is not using information from the future. And finally, because we are finding models by data mining, which we started with, which we were admitting that with data mining, and we're using machine learning to throw a lot of models at a system and figure out what works. Be wary of data mining bias. It is very likely if you try many models, something will work, just because it's just statistically likely that something will work out of so many models, but that doesn't mean you've really captured a trend. You've probably just it's just random correlations, spurious correlations. So be aware of that. Yeah, and avoid overfitting. And this is so important that I'm dedicating one slide just to this. Overfitting is the most dangerous pitfall of a trading strategy. People make these amazing complex algorithms, and we've been guilty of that. We would do that at Octave World. So we make a very, very complex algorithm, and you try and explain away every anomaly in the system, and you try and fit to everything, and it gives you an amazing backtest, right? And in a backtest, you see a small kink, and you go back and you fix your model to avoid those kinks and avoid any sort of drawdowns, and everything does well. And then when you try this data, when you try it on new unseen data, your model is going to just fail miserably. What that happens is you've just fitted really, really well to information that was available to you, but your model doesn't really have any predictive part. And this is why it is really important that you have a test data set that has not been tainted by any sort of training or validation. This test data, and only when you know that your model does well with this test data set, then you know that your model has some sort of a predictive part. One other thing, just try and keep your systems as simple as possible. Markets do not need very, very complex algorithms to explain them. So if you find yourself using many, many, many features, most of them you're not even aware why these features are there, or you find yourself using a very, very complex algorithm, it's probably you're just overfitting. Okay, these are just some snapshots of our toolbox, but they're all available on our wiki too. So if you go to the wiki, if you want to use our toolbox, the guide is really good. If there's something that that doesn't answer your questions, please let us know. We'll be happy to help. And this is our GitHub page, which has all the tutorials. We will be uploading an IPython notebook with everything that we talked about today very soon. That's a Medium page, which also has tutorials. I will be writing a post very soon on everything that we talked about today, along with this video. So if you missed, or if there was something that you would like to go back to, you can find it there. All right. If you have any questions or feedback, please reach out to us at our email. And we'll take some questions now. Thank you. Okay, so someone asked if the presentation will be shared. Yes, the presentation will be shared. You will be able to find it on our Medium page. We will upload a blog post very soon, latest by tomorrow. Someone is asking about the pricing of Auquan, the profit model. Well, this is not the best platform to discuss it, but basically we want people to learn about trading and solve our problems. And if you solve our problems well, then we have certain trading partners who actually use your solutions to trade them live in the market, and they pay us a share in the profits back for facilitating this. We split that profit. That we get with you. So we keep a part of it for facilitating this platform, making all these tools available, and getting people on the platform, and the rest goes out to people who develop the strategies. Okay, someone is asking how good are GV models proven to be in the competition, stuff like XGBoost or IGBM. Okay, I'm not going to answer just this question, but overall, after this competition, we realized that a lot of people were extremely overfitting, and I think that is a result of data mining, solving problems through data mining. I'm not saying it's wrong, but it is. You kind of need to understand what is it that your model does. Don't just throw a lot of models at the problem. So a lot of submissions, we found that they performed well on the training data set of the person who submitted it. They did not do so well on the validation data set, but then they went back and optimized and they got to improve performance. But so many of them, when we tried them on the test data set, just failed. So maybe 4 or 5 models, and in fact, 4 or 5 models did well on the test data set. Some of them did okay, but probably not acceptable. Of the models that did well, 3 of them were just simple linear regression. So they were just plain old feature selection, figuring out the right features, what actually explains the data, and just doing a regression on them. Okay, someone is asking, in a real-world example, how does your split work? Do I just keep adding new sample to my test set, or do you keep looking to split it up into your test and validation in the same ratio? So yeah, in the real world, as more and more data becomes available to you, it's also new information because market conditions change all the time. So you do want some of that new data also into your validation and your training set. So and also your test data kind of becomes tainted, like I said, once you test on it, right? So what we generally do is, as more and more information becomes available to you, we move some of the data from our test set into validation and training sets. So we kind of keep rejigging the training and validation sets, and we move some data from the test up into that training and validation bracket. Quick question, is there some better way than rolling cross-validation as well, used in the industries? Yeah, so some of the things that I didn't talk about but are in the presentation, like I was talking, are bagging, boosting. Those are actually, boosting actually is a very common technique. What boosting does, I can quickly go back to it. What boosting does is you take a model, you take some random data points from your training data set, and you train your model on that training data set. And then you test your model on the training data set itself. So you're testing your, go back over here actually. All right. So yeah, you randomly choose some points from your training data set, you create a model, you train it, and then you test your model using data points from the training data set itself. That will lead to some prediction. Based on this prediction, you can calculate your error. And your error is used to then reweigh your training data set. So now when you choose your next set of data points, each data point is weighed by previous model error, which means that points where you did not predict so well are more likely to occur in your bag that you're using to train your model. And then you re-optimize and retrain your model, and you come up with a new prediction. And now you do some sort of a small ensemble learning here, and you make you combine these two predictions, you come up with a predicted, like a mean prediction. You look at the error of this mean prediction, and then you go back and weigh your training data sets with this error again. And now maybe you're predicting the points that you were not predicting earlier better, but there are some other points that are not getting predicted well. And now when you choose your third sample again, those points are more likely to be predicted, and then you re-optimize your model and you make a new prediction Y again, and then you just repeat the whole process again. So basically at every step, you're picking points that you haven't predicted and retraining over them. And then once you're happy with with what you've done, you test it on your test data set. Okay. If you have more questions about boosting, I know this is like a very quick introduction. I would recommend reading about it online. I will also post when I write a blog post about it. I will write links to these concepts so you can read more about them there. Okay, someone is asking, can you tell about October trader role? Was it offered to Conquest winner? When will next Conquest take place? Yeah, so I think about 10 people or so are interviewing with October right now, and we'll know the results of those interviews soon. But yeah, a bunch of people from Conquest actually interviewed. Next Conquest will happen either in December or in January. So we're working with an asset management firm in Singapore now to set up our next competition. And once our problem setup is complete, the first part, remember, setting up your problem, which actually people don't realize but takes quite a bit of time. So once the problem setup is complete, then the competition will be live, but expected in December or January. Okay, I think that's it for questions. Thank you guys. Thank you so much for watching. If you have more questions, please do reach out to us. We'd be happy to help you. Anything, if you have questions about the presentation, about Toolbox, about Auquan, we'd be happy to know. Thanks.